Welcome back, everyone. Episode 118. Keith running the show here, so this is the first time behind the scenes. So, well, hopefully it gets recorded.
Could be a challenge. We'll see.
And there's the big man's voice. You hear Mike Banger in the house, which is nice. It's a little treat we have, and then we have Sara and TJ. So, should be a good show. Next week, Lisa will be back from her seems like a month-long vacation, but it's only been a few weeks.
Yeah, she's back in the home country, isn't she? In Austria. I like it.
Proper European holiday. Right?
Yeah. And she sent a couple of texts and pictures, I think, and looks like she's having a good time there.
Yeah, not a bad place to be at this time. And Tyler and I are doing a video a little later today, so I think he's Russ's vocal cords. So don't worry, everybody.
What do we have later on?
Well, we're doing a little insight series with the earnings. That's kind of been the market's been fabulous. We're going to talk a little sneak preview on that.
Okay.
It's now. So. All right, Sara, I'll turn it over to you. So this will be your first time kind of running this part of it.
Yeah.
What you got on your two truths and a lie?
All right. Throwing two truths and a lie at you guys. So every sector with a lower forward PE today than at the end of 2024 has underperformed the S&P 500 year to date.
Ooh, that's a lot of billion now.
I'm coming out strong. B, companies with less than 50% of revenue from the U.S. are growing earnings faster than the S&P 500. And then a little preview to our portfolio talk at the end of the episode. C, despite fierce debates, growth and value have delivered almost identical 5-year cumulative returns.
Who wants to start?
Seems like you're a super guest here.
Yeah, I'll go. I mean, I look at these three. I mean, C seems obvious. Growth has outperformed value, but my guess is value is having a better year this year and over 5. I'm going to say that's a truth. I'm going to say it's B. Companies with less than 50% of revenue from the U.S. are growing earnings faster. I think that's the lie. I'm going to go with B.
All righty. TJ, how about you? Throwing it to you.
Yeah, looking at going back 5 years cumulative on C there, growth versus value. You saw in 2022, that would push us back to August of 21. 2022, value significantly outperformed growth, but growth has much or significantly outperformed since. So I'm going to say that is true. B, companies with 50% of revenue from the... I'm going to say that one is true as well and go with the first one as the lie. Every sector. I don't know about every sector, but some of them has, but I'm going to go with A as the lie.
All right. Well, we're split.
Oh, wow.
Keith?
A lot of pressure. I want to or at least line myself with those two on C because I'm a growth guy, but for some suspicion, you kind of nailed it there with 2022 and markets down, being down more than value and value up this year. So it's, I think surprisingly, that one actually, you normally would ask me, I'd say, no, that's not the case. But I do think at this point in time that it's actually the case where I think C is true. Then B, the 50% of revenue. Oh, boy, that's some hard questions here, by the way. I'm going with TJ I'm saying A is not true. I don't think it's every sector. So that's my answer. A is false.
All right. Well, two of you got it right. A is false. Several sectors did see, PE compression and outperform the market. So, this suggests earnings estimates rose even faster than some of the stock prices. So, you had energy, materials, and information technology with lower forward PE today than at the end of 2024.
Okay.
And then
I was wrong.
Yeah, and then B, you had companies with less than 50% of revenue for U.S. So, diversified revenue across the world with 75.3% performance in the S&P at 50.4 on earnings growth. So that one was true. And then C, fierce, debates. We have growth at 75.1 and value at 74.9. So really? Almost identical. Yeah. At 5-year performance, looking at Russell 1000. So
that doesn't surprise me because over time they do kind of lay right on top of each other, even though any individual year can have a wide gap.
Yeah. No, that does right me a little bit. 'Cause, I mean, growth for the last decade better than value, but then you had years like 2022 and this year market's broadening out, and that's kind of why we always talk about diversifying portfolios. And that's why you don't think or Mike always big think or swim with one portfolio, right? You have a little bit of growth in it, a little bit of value. You just don't know exactly when one's going to take off going to the other.
And we talked momentum a bit last week too on, that's been, performer as well and kind of ups and downs, but it's kind of fun to follow those, different approaches, if you will, to that.
Yeah. I associate momentum and growth as kind of the same thing, but it's not always the case really, is it?
No, I mean, you've seen this year, especially like some of these semiconductors that they're not really growth multiples. Trading at 3-4 times of some of the kind of memory chips that it's really been the momentum days, but those really considered huge growth metrics, right? You generally speaking, growing faster and higher PE multiples, and higher price of sales. So
I'd be curious to see what the cumulative returns are of the S&P 500 growth and value, because that's one thing I've seen a large divergence by indice on how people categorize growth and value. You have the Russell 1000 growth. Significantly underperforming the Russell 1000 value, but the S&P 500 growth is actually outperforming the S&P 500 value year to date. So it is indice. Paying attention to the indices and what's underneath the hood in those funds is important as well too.
Yeah, that's a good point because everybody kind of classifies things different, whether it's a growth or value. Some are hybrid, some are obvious, and then even like in that whole discussion of what's a large cap versus a mid cap versus a small cap, everybody's definition is slightly different. All right, let's jump into kind of what we kind of alluded here and kind of what Sarah was touching on is earnings season. The market's been fantastic. When we're talking about the market, we're referring to the S&P 500. Last 3 years, it's been 26, 25, 18. This year, right now, mid-year plus a month in this change, we're at about 15%.
We're right on 15, back to 15% up. Okay.
So that's
okay. Yeah. Yeah. Well, it's above average. And then I think it took a lot of people off guard, especially after the strong 3 years we've had in the past. So, yeah. So the march continues upwards.
And the one thing that you and I, we're relatively newer, but the one thing that we always point to that key driver of the overall markets over longer periods of time is the S&P 500 earnings growth. And this season's been fantastic. Mike, you want to talk a little bit about what you're seeing and kind of put that in perspective?
Yeah.
I'm career and kind of where we are relative to past.
Yeah. I mean, you're right, Keith. We've always preached that over time, stock prices will follow earnings growth. And that's generally always the case over time. I mean, there's noise in between headlines that bring markets up and down, in the short term, but it's really, the resiliency of earnings growth over time in the U.S. market, and especially those S&P 500 companies that have driven stocks higher over the years. This year, I think we're forecasting 20% plus earnings growth for the year, correct? 2026 over 2025, which I haven't seen that in a long, long time. I mean, it's incredible. And I think stock prices, even though they seemed extended after the past 3 years, they're still moving higher this year because of that.
Yeah.
It's AI driven, obviously, and semiconductors are really going to the moon, it seems like, with their earnings and their stock prices. But I get a little worried about it when I look at this because I think, if we're forecast at 20% plus this year, consensus is probably going to be 15 to 20% next year. Is that right?
Yeah, they're in mid-teens, high teens.
And, there's this scenario where it's really tough comps, and I just, it seems a little bit intuitive to me that it's going to be hard to, do double-digit earnings growth on the back of 20% plus earnings growth. So we'll see. But I'm enjoying it right now because markets are hitting record highs, and it's all on the back of earnings growth for sure. And we'll worry about next year as we get a little bit further into this year.
And
Sarah.
I think what was interesting too is I know the topic for GI of the year was kind of the broadening out of the market. And we saw, this earnings season, all 11 sectors year over year revenue growth and 5 being double digits. So I think that kind of gives confidence to the kind of broad, strong earnings season where it's not just kind of concentrated in one or two sectors. It is that broadening out of growth across the board.
Yeah, I love those stats that you brought. And then kind of those sectors and industries that you mentioned that typically those aren't generally hyper growth kind of sectors that are growing, but materials and energy. Yep. We're seeing it from at broadening out, which is a healthy thing. TJ, got anything to add on kind of what we're seeing here?
I was just going to say that looking at the median stock earnings per share increase year over year, you continue to see that accelerate. And looking at the median, you're looking at the middle company out of the 3,000 there. So that is another data point that confirms the broadening out. One thing on the earnings that I have seen is just looking at the FactSite earnings insights is that since the beginning of the quarter, we have seen earnings per share for calendar year tick higher by a few percentage points. The only thing is that calendar year 27 has been lowered by a few percentage points. So it seems like the growth is being
there's that comp thing, tough comps. Yeah.
So the growth is getting pulled forward. It seems like from 2027 into 2026 there.
Yeah, no, that's
reiterates Mike's point.
Yep. I've been actually telling some advisors, investors the last few weeks that as bullish as I am on this year, and I still think we have a good finish to the year, I do think that we're kind of stealing a little bit of earnings from next year. And to Mike's point, earnings are great, but the only problem when you have these blowouts, I think it's around 26% growth this year, which that never happens coming out of a non-recessionary period. So we're just absolutely blowing out the doors on earnings. But then it's like, okay, next year or end of this year when we roll around, people will be like, okay, what's earnings growth rate? And I think right now they are that 15, 16%. But I think they could be overstated if we're getting more this year. And I think that's just going to make, to Mike's point, a harder comp for next year.
I think you're setting yourself up more so for a potential disappointment next year versus upside surprises next year. We'll see.
Yeah, we'll see.
We'll see. Yeah. It depends how long and how high this AI spend can go. But time will tell.
Another chart viewers aren't seeing it. Typically, when we go into the year, kind of TJ alluded to a little bit, estimates for out year are very robust. Analysts get ahead of themselves, and throughout the course of the year, they end up taking numbers down. That did not happen last year. Actually, up in this year, it's accelerating. Sarah, do you want to talk to a little bit of kind of what you're seeing and kind of some of the information we're out there?
Yeah, no, I think, to your point, I think forward guidance Q3 and beyond, I think has been positive too. So that gives, investors hope in a preview, as we, head into the latter half of the year here. So yeah, to Mike's point, let's see. I think, as investors, we continue to kind of, when it's good, but where could it go bad? And, keeping a keen eye on those sectors that, may have kind of a negative guidance going forward or may see some stress. So it's kind of a, wait and see.
Yep. Every quarter, we have to look at, what consensus expectations were for the quarter. Did they exceed those? Did they not exceed them? And then the other element is companies tend to give guidance, maybe for the next quarter, some give for the, reiterate or give guidance for the full year. And I think with what we're talking about, the surprises have all been overwhelmingly positive on both of those factors, on the current and the guidance. But I think as we get more into the third quarter and especially the fourth quarter earnings reports, we're going to start to get 27 guidance. And that's where the rubber is going to meet the road, and we'll find out.
Yeah. TJ, what are you saying there?
So the one thing there I've been kind of paying attention to is the percentage of companies that have beef and the beat rate. I think we reiterated that last podcast, but I'm just reiterating again as we move through another week of earnings season with about 90% of the S&P 500 reporting at this time. So you are seeing a strong beat rate from those companies. And I think that if that continues, that'll be able to help forward guidance continue to move forward. At these levels, at the beat rates that we're at right now, I would expect that to tick down a little bit moving forward, but stay above 5-year averages. So solid.
Yeah, I agree. And then kind of Sarah alluded to it, the fact that S&P earnings, let's just say round numbers are up 25% this year, like alluded to 15% for the S&P 500. The actual PE multiple evaluation metric that we look for is actually contracted. It's gone from 20 times to sub 20 or right around 20, which is a healthy thing. So that's the ideal situation, right? Where your earnings are outgrowing instead of, you get in markets sometimes, Mike, you can talk to us a little bit in the past where people get excited about it and you get it all by multiple expansion, right? There's two ways: you get earnings growth, or you can pay more for stock, that multiple expansion. What do you think is more healthier?
Well, what I think you're seeing is, there's this old saying that, when stocks have high valuations, investors justify it by saying, well, the companies will grow into their valuation. And that's kind of what's happening right now. We're getting strong earnings reports, and we're getting, big beats, and we're getting good guidance. So I think companies are growing into their valuations and actually justifying their valuations. So, things tend to get a little extended. Certain sectors, that always happens. There's always extended sectors in the market. And we kind of know that the AI play and all the, underlying stocks that kind of trickle down in the AI play, they're getting overvalued, and people are investing there heavily right now. But in general, valuations are very reasonable right now.
Yeah, I agree. All right. Let's
good segue. Yeah.
We're going to change gears here a little bit. We're going to, I think we were talking this week, Mike and I, they're on week 7?
Week 7.
You guys both started at the same time.
All right. These guys are going to be veterans here. Okay. I love it. Yeah. Yeah.
So Mike's a big proponent of making sure everybody's kind of, moving forward and kind of getting your opinions on record and kind of pushing people into situations maybe they haven't done before. So Mike and I think are going to ask you a few questions, kind of feel a little bit more about your investment style and kind of personality and kind of what listeners should, kind of, especially pay attention to when you're talking about. So, Sarah, we'll start with you a little bit. So obviously we manage roughly about, say, 35, 40 different portfolios here, and we have portfolio managers on it. And then we have people that are helping on the different portfolios. And Sarah, you've been helping me out on the G33, which is our all portfolio of it. And kind of, why don't you talk to me a little bit about investing in growth? We'll get to some more questions. I'm sure Michael jump in here as well.
Yeah, no, Mike teed it up great, but I think, this earnings season is a great kind of example of growth. And Keith, it's been, I know you're a growth guy, and it's been great to, learn from you and your approach over your career. But I think, with the focus on growth is those companies that, have the potential to grow earnings faster than the broader market. And, Mike told me too, and we just touched on it, sometimes these stocks can look expensive from a valuation perspective, but it's really that forward perspective of, what is their potential to grow into that valuation. And I think there's different growth approaches. There's, growth at a reasonable rate, and there's kind of that pure play growth where, you're willing to kind of buy an expensive stock with the expectation that they'll grow into that valuation. But I think, fundamentally you have growth, revenue, earnings consistently above, that 10% mark. And, really, as we touched on earlier, I look at, what are the revenue segments? What is the revenue diversification? Do they have revenue coming in from, the broader world, from just the U.S., because that, as we just touched on, has an impact on, growth as well. And then kind of that strong and expanding profit margin, and the moat topic, what is their competitive advantage versus their peers? What is the peer set? How have they been doing? What are industry tailwinds or headwinds? And I really like to open up, the 10K and the 10Q and really get in those documents and read through them. And
use it to Mike's ears.
And really, hear from the company. So it's been fun, looking at the growth. In the G33, you kind of have growth across that large cap, mid and small cap as well. So picking the areas of what are the industries that we like, and then do we feel like we want to, allocate to more of a large mega cap stock, or do we think some of small caps had a great run this year? Do we think, those segments could provide greater growth than the larger part?
Yeah. When I look at our team, Keith is a growth guy, but I, historically I've kind of seen him lean into the growth at a reasonable price, arena. What we haven't really had, and I've pushed Sara to look at, is there's always different smaller sectors in the market that are accelerating, and people think there's going to be outsized revenue growth in the next few years for these companies. So they're really doing what I call forward investing. I mean, they're investing in companies that they think you really can't justify that growth based on earnings or a PE multiple. You got to take a leap of faith that the earnings growth is going to be outsized and the profits will follow and cash flow and those kind of things. And that's where you really get some outsized stock moves, I guess, over time, is finding that outsized revenue growth, and that tends to be a theme in an industry. And there's a whole segment of the market that is just flat out, I'm looking for revenue growth. I don't care about valuation. And that's where I'm buying. And that's a true growth investor, in my opinion. So that's where I pushed you in that arena, Sara. And so far, so good. We'll see how it goes as you become, longer tenured here.
Yeah, she's certainly has some great ideas.
Yep.
So we'll pay attention to what she's saying. And then TJ, talk a little bit about kind of you're working a little bit more on maybe on the opposite end of the spectrum, and Mike's kind of tasked you in that.
Absolutely, the opposite end. Yeah.
You know, talk about how you see the world and the lens through more of a value kind of.
Yeah, looking at value and deep value in particular, with looking at the the contrarian choice there, and looking for stocks that have price dislocations from their intrinsic value. So fundamentally, what a company is worth versus what the market is currently pricing at. We want to see a big gap between that, or not necessarily a big gap, but one that we think the gap can close, and those prices are going to revert and normalize over time. So we're looking for outsized price appreciation, but more specifically with the deep value stocks, you're looking at stocks that are trading at low multiples. So PE, price to book, price to cash flow. You're looking for cheap stocks. The one thing that you can get into a trap is obviously the value trap. The people say that they're cheap for a reason. Something's structurally wrong with their business. They lost key management. They have customer concentration and they've lost a big customer. So we're looking for catalysts or stocks that what I'm looking for, some characteristics, and some of those stocks is, like I touched on, the low valuation, but a strong balance sheet as well too. So they're not over levered. Their balance sheet is going to help them weather the downturn, however long that is. Got to have a big or strong balance sheet to weather those downturns. You're looking for a strong moat as well too. Your products or services that you provide are protected in a sense and can be moved on into the future. And then looking for attractive risk reward. So how much upside do I have to my intrinsic value versus how much more potential downside risk is there with that? So I'm looking for an attractive risk reward ratio when looking at that upside and downside.
Yeah, great answers on you too. Mike, you got some questions for you?
Yeah, I mean, I've always had kind of a vision on the contrarian choice, and I see it as I really want a bunch of down and out companies in that portfolio. And generally a down and out company to me means that isn't structural, a company that's not structurally changed, but just has some misexecution or a misstep along the road. The market tends to overly punish companies that have an execution misstep, I'm going to call it, or a quarterly miss or something like that. And they tend to, drag these stocks down to ridiculous levels. And if we can get, a portfolio full of those, and try and get it, as close to when the misstep is over and they get back to normal again, that's what we really look for there. And it really is, in my opinion, kind of a true Warren Buffett style of investing a little bit. That's what he always does and what he looks for. It's tricky business because you're not sure if you don't know how many quarters the company is going to be misstep, or how many quarters it takes them to recover from a misstep. You want to try and get it as close to the recovery as possible, but that's easier said than done. And, and then trying to find out if the company is truly structurally different. If their products are passe and kind of obsolete or whatever it may be, right? Or if it's just something that's going to recover later. So it's a tricky portfolio, but it can be rewarding if we get it right. So, so we got TJ on the path there.
Yeah. You got some examples of a couple of stocks or a stock that kind of amplifies what you're talking about?
Oh, yeah. I mean, personally, this is kind of where I tend to dabble a little bit and things like that. So,
people want to hear.
You know, like when software was just getting clobbered not that long ago, I thought ServiceNow was just ridiculous because their numbers were good and they kept moving and all that. So software, I think, was an example of not only a stock, but a sector that was out of favor really for no reason. You know, right now, I'm looking at things like, maybe Nike is one. I mean, Nike has just been battered. They've certainly had a couple of quarters of missteps. When that tends to happen, investors tend to just bail and move on. So I'm pretty sure Nike is going to be around down the road, and we'll see. But
great earnings season this quarter.
Yeah, so that's one that we're looking at a little bit, and thinking about. So it's really names like that.
Yeah. You seen any kind of sectors or industries that's kind of, there's a lot more names or opportunities maybe you're seeing right now?
Yeah, that's one that I was honestly looking at right away, was going into ServiceNow and the software pull down that you've seen. The split between software and semis was just, it seemed like the gap was just too wide and that it wasn't going to potentially widen out even more. Now it could stay at that wide level because there are a lot of risks. But ServiceNow in particular, they got their ServiceNow AI platform going on. So they're helping out with IT tickets. They're helping out with customer support. And they're seeing a lot of growth in that area and just hit $1 billion in revenue for that business unit there. So that was attractive, but the bounce back can be quick. I was taking a look at it a couple of weeks ago when it was at, 90, low 90s. And it's back up to 120 real quick. Yeah, so you see that
for Mike's time was a big opportunity.
Yep.
Big opportunity.
I mean, it really is. I mean, Sarah on the, on the growth side is looking, to find these companies that are in the middle of a parabolic move or kind of in the early stage of a parabolic move. TJ is trying to discover companies that have been hit on a parabolic downside move, and trying to sort out when they're going to recover and if they're going to recover. So they're opposite ends.
Yeah. So you got any themes in the growth that's kind of interesting as a whole? You only like to invest in kind of.
Yeah. Yeah. And I kind of think of it, similarly from a thematic perspective. I think, industrials have, a lot of tailwinds, mega trends really of decarbonization, the electrification of the grid, and, AI data center, high defense spending. So looking at, some of those mid cap, industrial names, across the board. And then I think, healthcare as well. You have, strong, tailwinds there as well with the, aging population. I think Eli Lilly is a name that you like as well, Keith, that, though I know biotech's kind of had a great year here, but, where do we want to play? Is it more of that, reputable name, or is it, taking chances on some of more of those, biotech names? And then financials has had, a great year as well. And then, fun one I've been looking at too is kind of the physical AI robotics. You have SpaceX being the big one, but, you have NVIDIA CEO on record saying, every industrial company is going to become a robotics company. So how do you kind of think through AI coming out of the data center? What will that physical world look like? I remember going to Phoenix and seeing the Waymo cars on the streets.
Those in Phoenix too.
Yeah, it's interesting, right? But what will the world look like, and who will some of those growth names be that are going to drive that physical AI as well? So that's been a fun one to look into.
Yeah, you too. I think we kind of placed you in the right kind of with your background, how you look into the world. And again, there's no right or wrong. They're both the ways of investing. It's just a little bit different.
Yeah, you can be successful in both arenas of those investments. Yeah,
for sure. All right, we'll change gears here at the end to get a lot more time. We're going to talk about a little bit of fun stuff. Mike, we'll start with you.
Okay.
OG here. It's just kind of, how did you ever get interested in investing? And then we'll have the same question for TJ and Sarah.
Well, I mean, I grew up in investing. My dad was in the investment business. He was actually on the fixed income side. He worked for a company called Kidder Peabody for most of his life. I think Kidder Peabody went through several buyouts and companies, but I think now the old Kidder Peabody would reside in UBS. but I kind of grew up in it, and it interests me, and I'm always interested in trying to make some money. And, and I never really took to gambling much, like blackjack or things like that. But, I tried to make money in stocks. And so I just always liked the stock market. It was challenging, and I've always been involved personally. And I'm not really a buy and hold kind of guy. I'm more of a trader in individual names instead of indices and ETFs and things like that. So I just enjoy it. It's fun for me.
For sure. TJ?
Yeah, I've always had kind of a math background and understood numbers very well. I kind of got into investing a little bit at an earlier age, not necessarily investing in certain stocks, but just, from a standpoint of investing in myself and my education, I went towards a more of a route that would be fit for the stock market, finance, and economics. And then once I started, dabbling in the stock market a little bit and got some first big boy job and got some income flowing through, started putting some money in the market, and you start to see that kind of go up, and you start to realize what the potential of this could be. If not only, some people take a little bit more of a short term mindset, but, 10, 20, 30 years out, once you get that compounding going there with that. So that's kind of my background. Is numbers oriented. I always understood math and everything. And that's what, part of this is. And there's also, as I've learned in behavioral economics, there's also a big psychological aspect of it too. So
it'd be nice if we got the black box with the numbers guy, but yeah, it worked that way. Yeah. Sarah, how about you?
Yeah, no, this was a fun one to think back on. I think I got interested in investing at a young age, and maybe for some of our listeners with kids, my parents took the approach of, I earned $5. They set up 3 mason jars. One was save, one was, spend, and one was give. Oh. And I always, I thought that was a good approach, right? Of you have your 3 buckets, and the fun one is the save and the invest. And I was always kind of curious, what can I do with that $3? Do I let it sit there? Can I double it and that kind of stuff? So I think that was a good approach that my parents took from an early age, of kind of the foundations of what to do with your money.
I love it. Okay. So that's good. I like what they did.
Sure.
Keith, tell us how you got in here. What?
So, a little bit similar to TJ. I had a strong math background. I grew up in central Minnesota. I was, what the stock market was in high school. I used family didn't have money, so it wasn't part of any conversations from the house. Once I got into college, and then started, hearing about the stock market, and it interested me in numbers and math, and then all of a sudden, Mike and I are old enough. We actually didn't have computers back then. You actually had to open a paper and then buy stuff. So, Mike, you remember your first stock you bought?
I don't remember the first stock I bought. I've bought and sold so many stocks over the years. But the thing is, and I know I'm getting into one of the next questions here, but the thing about investing is you can't get sour on a failed stock and let it, affect you. Because I've always kind of talked about, look, if you can pick 6 stocks right and get 4 wrong, you're going to have a great career. Versus index investing. So you got to get used to having failures. And, I've had some grand failures in stock picks over the years, but I've also had some good success. So, it's just, it's interesting that you guys both said, okay, my strong math background got me into this, but there's elements of math and there's discipline and things like that, and, ratios and all those things you look at. But to me, investing is almost a little bit more than art and science. Sure. If it was just science, there's people a lot smarter than all of us here that would have figured out some algorithm and everyone would be rich, So it's very much like you said, psychology is involved in it. And, you have to know the terminology in the background and, have some math skills and all that. But at the end of the day, it's, taking a leap and hoping you're ahead of everyone else who's taken the leap. So there's a lot of psychology involved too.
Yeah. So my first stock was back in college as another older guy that I knew that worked for Kraft and Philip Morris. You remember those things?
Oh yeah.
He was a big cigarette guy, and he's like, "Oh, you got to buy RJR Reynolds." I'm like, that was at the point in time I was looking at Best Buy. That was when they're very early in Best Buy was just starting out, right? Electronics, it was kind of the boom. This is mine, like early 90s or 80s. So I end up getting on myself, and I guess into my RJR. I think we end up a couple years later down 20%, and I took a dividend along the way. Who cares? I think Best Buy was like a 10 bagger in that same time period. I'm like, geez, I missed out. So I think that's where my growth investing really started.
Mm-hmm.
So, all right, one more question before we end it here. TJ, any stocks that kind of stick out as kind of learning lessons, good or bad?
Yeah, the one I would say that on the bad side was Zoetis, animal health company. A lot of people post-COVID were getting pets and spending a lot of money on their pets. A lot of money.
A lot of money.
Yeah, there was some big spending going on, and what I didn't forecast and see is that eventually all that earnings and how well that company was doing was going to invite other competitors, and they were going to try to take their market share away at that time. I had thought that, continuing, with, the younger generations not having as many kids right now and really putting a lot of money into their pets, that was going to, continue on. And then they had the farm animal health as well. So your cows, your horses and all that. So I thought diversified business between that, but I didn't foresee the competition significantly increasing and taking market share away from them. So
good lesson learned though.
Yeah. Mm-hmm.
Yep.
Yeah, no, it's similar kind of COVID story for me. Peloton.
We're starting to sweat.
Oh yeah.
That was an industry that was interesting. I love, working out and going to workout classes, and they kind of brought that into the home, during COVID. And I think, they were up over 700% within a year.
That
and
stock
then
was
down.
all the rage. Yeah.
Yep.
Yeah.
And then, fallen, 100%, all within 2 years. So
yeah, that was a stock that went from a parabolic upside to a parabolic downside into, like you said, 2 years. Yeah. Yeah. It was all the rage at one point. Yep.
That makes sense with your kind of interest in growth, right? 'Cause that was certainly you if you timed it right, if you bought early when it was just coming out and then you sold correctly.
Exactly. Yeah.
Made a lot of money, but then if
sounds easy, right? Buy low and sell high. It's simple, right?
No, I agree with you. I never owned Peloton, but it certainly seemed like a interesting.
Yep.
Conceptually, but kind of all parts. So I guess that was a little bit of a learning.
A little bit, yeah.
Yeah. Mike, you got any big? I mean, you do vision so long, and I know you have.
Well, there was one spectacular flame out I remember, and this was it was called. I can't even remember where I got the idea from, but the company was Timbuktu Gold.
I love that.
And I mean, this is probably in the early 90s, maybe. And they were supposed to have like the largest potential gold discovery in Africa somewhere. And God, I think there was probably, half a dozen of us when we worked at Lutheran Brotherhood that were invested in this thing.
Oh, that's right.
And I remember it was going up. We bought it. It was going up spectacularly, and we're like, everyone's high fiving each other. And then all of a sudden, one day, it was just halted. And it turned out to be a fraud and misstatements and all that. So I mean, for the longest, I think for weeks it was halted. So it had this high valuation on your statement. Then finally they unhalted it, and it just dramatic, dropped like 90% in one day, that kind of thing. So yeah, Timbuktu Gold. I remember that one. Yeah.
Little lesson for everybody out there is, these are three professional sport, including myself, and we've all had these mistakes.
Oh yeah.
We learn from them and move on. And hopefully, Mike, what do you told this to Tyler, and he's mentioned it many times when he first started. What kind of a good batting average? I mean, should we be batting 9 out of 10?
Nope, 60%. Just like we said, I think 60% is going to be something to shoot for.
60% is awesome, and then you allocate a little properly and a little bit heavier weight. Those 60% that does wonders for it. It doesn't sound like it's not a game we have to get 8 out of 10, right? If we can get 7, put risk kind of parameters on there, I think that's a wonderful way to.
Yep. That's why you have a portfolio with multiple names in it, so you can because you understand that there's going to be failures, and you just want more wins than failures. You think of an index. I mean, the index has half the stocks are outperforming and half are underperforming, right? So if you can do a little better than that in your portfolio, you'll be good.
Thanks. Mike, thanks for coming to the podcast.
Appreciate it.
It's always nice.
Before we drop off here, tell you, TJ, how's your 7 weeks been so far?
First 7 weeks have been great. Getting comfortable with the stocks in the Contrarian stock portfolio. So just got through earnings season, listened to all the calls on there, trying to understand better the stock drivers of performance.
Yep.
At learning and getting better at understanding the FactSet system, very powerful system. A lot of data and information there. And then I would say the overall team has been great, meeting new people, not only in creating investments, but in the whole creative financial group.
Yep.
Some common interests. And really enjoying it so far.
Great. Sarah?
Yeah. No, likewise. It's going great. The team has been awesome, supportive, answers any questions. And it's been fun to kind of, see how everyone works together, whether it be within portfolio management itself or how we work with the marketers, how we work with the advisors, just kind of observing that on a day-to-day basis has been great. And then, getting to know the portfolios and, some of the media side's been fun doing things like these. And
Good. Well, Keith is expecting big things out of you guys. I mean, you're young talents. You're learning the stock picking trade. I mean, but it's a fun business. You're going to love it as time goes by.
Yeah. Look forward to it. Welcome to addition to the team. So, all right, everybody, like and subscribe.
Thank you, Keith.
Thanks.
Thank you.